Welcome to the deep dive.
Hello.
Our mission today is very laser focused. We've gone through the entire Q3 2025 FUBO earnings call, and we filtered it down to just the key strategic vision from one person, David Gandler, the co-founder and CEO.
Right, we're cutting out all the extra noise.
Exactly. No deep dives into the financials, no regulatory stuff. We just want to understand his opening remarks of the path he's laying out.
And the context for this call is just so important. This isn't your average quarterly update.
Not at all.
No. This happened right after Fubo's massive successful combination with the Hulu Plus live TV business.
A huge deal.
It is. This one event creates a completely new baseline for the company. They went from being this, ambitious challenger to a major market player almost overnight.
Okay, let's unpack this then.
Let's do it.
Our goal here is kind of three-layered. First, what does this new scale from the merger actually mean?
Yeah.
Second, we need to look at the Q3 numbers that proved the FUBO model was already working before the deal.
A very important point.
And finally, what are those four big strategic drivers Gandler talked about for getting the new combined company to long-term profitability?
Right, and he set the tone on that immediately. Right at the top, he called the merger a, quote, defining moment for our team and our shareholders.
And the immediate impact is all about scale. It's almost hard to overstate how much this changes things.
It really is. It totally reshapes the competitive landscape.
Absolutely. The sources confirm this deal immediately forms one of the largest live TV streaming services in America.
And they now have a total subscriber base of nearly 6 million subscribers.
Just in North America.
Just in North America. And if you pause on that for a second, that number gives them incredible power.
Right.
Gandler cited some recent UBS estimates that suggest this new massive footprint makes the combined company, get this, the 6th largest paid TV company in the country.
Wow, 6th largest.
Think about what that does. You go from being a smaller player trying to get good deals to a powerhouse with real leverage in those programming negotiations. It's a fundamental shift in the business.
Which makes their branding strategy so interesting. Because normally, after a merger this big, companies try to streamline everything into one brand for efficiency.
Sure, cut costs.
But the CEO said, no, we're expanding choice, not forcing one bundle. So why run two huge separate platforms?
Because it's about differentiation, not just numbers. Gandler was really clear on this. The two products serve totally different needs.
Okay.
FuBo is, and he says it will stay, laser-focused on its sports identity.
Yeah.
The branding, the features, it's all for sports fans.
That's their core.
That's their core. Hulu Live, on the other hand, he describes as more of a general entertainment bundle that has sports.
And here's the kicker, right? The part that makes it all make sense.
This is the really interesting part.
It said the two companies do not have any overlapping customers.
Zero overlap. That's a massive insight.
It means the merger is 100% additive. They just bought 4.3 million customers who were never going to sign up for the sports-first FUBO,
Right. So they didn't just buy subscribers. They bought a whole new market segment without eating into their existing base.
It's a perfectly clean scale-up.
It is. But to really get the confidence behind this merger, you have to look at the foundation FuBo built on its own in Q3.
He spent a lot of time on that, didn't he?
He did. He wanted to emphasize that FuBo was already doing exceptionally well before the deal even closed.
So let's look at those standalone numbers. FuBo ended Q3 with 1,630,000 paid subscribers in North America.
Yep, and brought in $369 million in total revenue.
Which he called their strongest third-quarter performance to date.
But the real victory, the thing that matters most here, is the profitability milestone.
Right.
Gandler reported their second consecutive quarter of positive adjusted EBITDA.
And for anyone who doesn't follow this sector super closely, positive adjusted EBITDA basically means your core business is now covering its own operational costs.
Exactly. It validates the whole model. They're not just burning cash to grow anymore.
And the data underneath shows how they did it. It wasn't just, random luck.
No, it was all about efficiency.
Trial starts were up, sure, but the conversions from a free trial to a paid subscription, they meaningfully improved year over year.
And this is the big one.
The churn rate.
Churn. The rate at which people cancel declined by nearly 50% versus last year.
A 50% reduction in churn that's phenomenal.
It's incredible. It means the product is stickier, the pricing is right, something is working.
And what's more impressive is that he said they did this while
reducing marketing spend.
Right, in a quarter packed with competitive sports. That shift From just buying customers to actually retaining high-quality ones, that's the key to their whole profitability path.
And that strong foundation lets them innovate on the product side to make it even stickier.
Yeah, he talked about specific features that are driving demand and engagement. They're not just a content distributor, they're a tech company.
You pointed right to the FuBo channel store.
Which is like the Amazon Prime Video channels model, right?
It's a great analogy, yeah. It lets them offer third-party services, like your regional sports networks or Paramount Plus, all inside the FuBo app.
So it simplifies billing for the user.
It does, but more importantly, it lets FuBo control its own bundle costs while still giving you max choice and keeps you on their platform.
And then on the other end of the price scale, they launched the FuBo Sports Skinny service.
Right, a lower-priced, high-value option. It's got a ton of top sports, including most of the ESPN content.
And he said that's driving record trial conversions. It's a smart way to get people in the door.
And once they're in, it's all about engagement. It's not just the content. It's features like multi-view, game highlights, push notifications.
The catch-up to live feeds.
Yeah, all these personalized things that make you spend more time on the platform.
Yeah.
And now they can scale all of that across almost 6 million subscribers.
Okay, so this brings us to the future. This strong Q3 plus the new scale shifts the focus to synergy.
Right.
And Gandler laid out 4 major drivers for growth and profitability. What were they?
Programming efficiencies, ad tech uplift, marketing at scale,
Specifically through the ESPN ecosystem.
and deeper personalization.
Let's break down that marketing one because the Disney partnership is just colossal there.
It's a game changer. They get to leverage the entire ESPN ecosystem. ESPN Radio, ESPN.com, the app, a platform that has, what did he say?
Somewhere in the sort of 100 million monthly active users.
100 million. Gandler sees that as this huge untapped value for driving profitable growth.
So it's like they're trading expensive, scattered digital ads for this massive, highly targeted marketing engine.
Pretty much. Now, it does rely on Disney's cooperation, so there's some risk there.
Sure.
But the advertising upside is just as big. Disney is taking over ad sales.
And what does that mean in practical terms?
It means they'll integrate FuBo's ad inventory into Disney's ad server. He said they're targeting Q1 for that. This lets them get Disney's much higher ad prices, their CPMs.
And you can already see this efficiency focus in the standalone numbers from FuBo.
You can.
The CEO reported a 68% increase in net ads year over year.
While decreasing sales and marketing as a percentage of revenue by 21%.
He credits AI for a lot of that, using it for channel optimization and creative testing.
Which brings us to a really crucial metric he mentioned. How efficiently they're getting new customers.
Right, the subscriber acquisition cost, or CC.
Exactly. He said FuBo is currently operating well below the low end of their target, which is 1 to 1.5 times their average revenue per user.
So in simple terms, they are acquiring new customers very, very profitably.
Extremely profitably, which is exactly what you want to see before a massive expansion.
Okay, let's pivot away from North America for a second. He also talked about the rest of world strategy.
Yeah, he called it core to the business and said he's very bullish on it. Streaming is a global model, after all.
So what's the plan there?
Near term, the focus is on migrating Molotov, their French streaming service, onto the FuBo platform. But his long-term ambition is still huge.
He wants to be the world's largest live TV provider.
He does. And he sees a path to partner with Disney internationally, pointing out that Disney Plus already has over 100 million international subscribers.
So what does this all mean? Let's connect this back to the long-term financial targets they set out years ago.
He was very confident. He basically said, we're almost there.
He reiterated the big goals. Around $100 in average revenue per user, 30% gross margins, driving 15% EBITDA margins.
And he said right now they're sitting at roughly around 20% gross margin.
So they need another 10 points of margin. He was really specific about where that comes from.
He was. It's a clear roadmap. He's expecting about 300 basis points, that's 3% from programming efficiencies, which the new scale makes possible.
Okay.
Then another 200 to 300 basis points from that ad uplift, thanks to the Disney integration.
So that's about half of it.
And the rest comes from G&A efficiencies and tech improvements. The merger is the key that unlocks all those remaining margin points.
And it all seems to come back to their tech advantage. He kept emphasizing their use of AI.
Right, not just for boring back-end stuff, but for user-facing features. Using AI to recommend shows, to automatically create sports highlights.
And using that tech to stay disciplined on costs, even while removing a significant number of channels.
So when you step back, what this deep dive really shows is a streaming company that, it hit these critical profitability and efficiency goals on its own.
And then use that momentum as a springboard for this massive scale-up transaction.
Exactly. The CEO clearly believes that the original FuBo platform, with its tech and its sports identity, is going to be the growth engine for this much, much larger new company.
Which brings us to the final thought, that kind of provocative question for you to consider. The CEO is totally committed to keeping FuBo's distinct sports identity and consumer choice model. But
there's always a but.
Right. As they integrate more deeply with the massive Disney and Hulu tech and advertising ecosystems, how hard will it be to really maintain that independence?
Is FuBo actually strong enough to dictate the terms of this synergy? Or will it, inevitably get absorbed into the bigger structure as time goes on?
That's the big question. It's a balancing act between that synergy and their identity.
And that tension is going to define everything for them over the next couple of years.
A fantastic deep dive. Thanks for walking us through what was a really complex but really defining earnings call.
My pleasure.
And thank you for joining us for the deep dive. We'll catch you next time.